Imagine two people starting their financial lives at the exact same starting line. Same salary, same background, same goal to build wealth. Yet a decade later, they end up in entirely different tax brackets. Meet Arjun and Ravi. They grew up in the same small town and landed their first jobs at the exact same time, both taking home 35,000 rupees a month. Neither had a trust fund or a wealthy uncle to fall back on, but here is where their paths split. Arjun chose the route most of us are taught, total safety. He routed every spare rupee into a basic savings account, guaranteeing his balance would never drop and keeping his financial life completely tension-free. Ravi took the opposite approach. He deliberately carved up his capital. He kept a portion in safe options, but actively pushed the rest into medium-risk investments and high-growth assets. To Arjun, this looked like insanity. He looked at Ravi's portfolio and saw reckless gambling. Why put hard-earned money anywhere it could potentially vanish? It brings up a question we rarely test in real time. Does keeping your money perfectly safe in the bank actually guarantee you'll build wealth? Or does that safety net secretly ensure financial stagnation? 3 years into this experiment, Arjun felt completely vindicated. He slept soundly every night, never checking market news, sitting on a steady, guaranteed 3 lakh rupees. Ravi, on the other hand, was getting knocked around. He watched individual investments tank, dealt with fluctuating markets, and regularly questioned if he'd made a massive mistake. But when they finally compared accounts, the math told a surprising story. Even with those individual losses, Ravi's high-growth winners had more than compensated for the duds. His portfolio had climbed to 4.5 lakh rupees, leaving Arjun's 3 lakh in a rearview mirror. This chart explains the exact relationship between risk and return and how low-risk choices operate. You stay anchored near zero risk, but in exchange, you are locked into small, flat returns that barely move. Watch what happens when we move up. To capture exponentially higher rewards, the line has to swing wildly side to side. You cannot physically reach that higher yield without traversing the volatility. The turbulence Ravi experienced wasn't a punishment for making bad choices. That volatility is simply the mandatory price of admission required for asset growth. Then came the ultimate stress test. A severe economic crash hit, and global markets violently plunged, sending average retail investors into a total panic. Arjun watched the news and felt like a genius. From his perspective, the crashing prices were undeniable proof that his hoarding strategy was the only rational way to handle money. Ravi watched the exact same news, saw his net worth dropping by the hour, and did something deeply counterintuitive. Instead of panic selling his depreciating assets, he took his fresh income and kept buying. He recognized a critical distinction. Selling in a panic converts a temporary drop on a screen into a permanent, mathematically realized loss. Holding through the drop simply means enduring temporary uncertainty. Widespread fear creates an artificial discount on solid assets. By buying while everyone else was selling, Ravi was turning mass economic panic into a calculated mathematical advantage. During a crash, investors often mistake a temporary price drop for a permanent loss. The actual danger lies in total paralysis, standing still while high-quality assets are trading at a once-in-a-decade discount. 10 years after they first sat down at that tea stall, the results of this A/B test were locked in. Arjun's slow, steady growth provided him with basic security, but it permanently priced him out of actual financial freedom. This chart shows the final tally over a decade. Ravi's wealth pulled away and multiplied because he gave his diversified, calculated risks the full 10 years they needed to compound. Arjun discovered the hidden danger of absolute safety. By avoiding all market volatility, inflation slowly eroded his purchasing power. He took the risk of staying stuck. The 10-year experiment leaves us with a strict mathematical reality. Low risk dictates low returns. High potential returns strictly demand higher risk. Wealthy investors treat risk as a manageable variable. They calculate their tolerance, diversify their exposure, and allow the cold math of compounding to do the heavy lifting over time. Which leaves you with a choice about your own money. Are you going to stay trapped on Team Safe? Or are you ready to learn how to navigate team growth? Let us know down in the comments.